Hello, good morning, good afternoon. Thanks for joining. We're about to start. We still will wait another 2 minutes to let other people to join. I mean, we were lucky and had a lot of registrations. So let's wait 2 minutes. Thanks for joining on time. For joining. How many we have now? 15. Let's wait another minute. See the number of participants increasing, which is good. All right, so I think we can start, and we have more than 20 people joining. So again, lots of greetings from Munich, Germany. Thanks for joining. We are from Squalify. Just very quickly, Squalify is a venture, almost 2 years and a half in the markets. We are a subsidiary, or let's say fully funded by Munich Re, which is the largest reinsurer. And today we are going to be talking about cyber risk landscape. We're also going to get a bit into predictions, and also, I mean, with an insurance background, insurance companies, they like to make predictions, but always based on facts, also based on what has been learned from the past in the previous years. So thanks for joining, and we have planned probably 30 minutes to go to some of the topics, and we will love to have an interaction at the end, so really give you the chance to ask questions. So we would like at least to have 10 minutes at the end for questions. Feel free to post questions or comments during our slot. We can pick those questions towards the end, but obviously also feel free to raise your hand or just ask questions when we get to that point. Today, I have with me Herman.
Yes,
Hello, Herman.
welcome.
Nice to see you.
Welcome also from my side. Yeah.
Who's Herman?
Yeah, I'm the founder of Squalify and the strategic advisor here. And yeah, I'm happy to be and join you, Astrobal, in this webinar.
Herman, you come from Munich Re, right? So
Yes.
I've heard you spent a lot of years at Munich Re.
Yes, and the idea was using one of our core capability of Munich Re, calculating cyber premium for cyber insurance, to use such an algorithm to quantify the original risk for large organizations. And that was the starting of the whole journey to come up with a separate company to sell software as a service based on such an used and proven algorithm.
Perfect. Well, you're already hinting what Squalify is doing, which is great. So we provide a quantification solution as a product. And actually, I'm glad we're having this webinar today. The timing is amazing because I just came back 2 hours ago from a technology predictions event in Munich from Forrester here in Munich. And some of the things we are going to share is also things we have learned. Obviously, I didn't have the chance to update the slides, but there are some interesting findings. And we'll talk about the predictions, of course, the whole topic of cyber and cyber risk. It's very present. So before we get into the, it seems someone is talking.
Not muted.
If you don't mind muting yourself, well, hearing someone in the background. Yeah, before we get into the topic, just share some of the demographics and what we have today. I mean, we got more than 50 registrations, so it is very great. You can see here the level of seniority is pretty good. So we have 46% C-level people and 27% senior managers. So pretty 75%, 3/4 is senior audience, which is good. If we look at the maturity when it comes to cyber risk quantification, of course, looking at quantification as part of your cyber risk strategy and the top challenges, what we're seeing here, Herman?
Yeah, I think that is a fair representation of what you've seen in other surveys regarding CRQ maturity. Only rather a few are advanced or really actively using cyber risk quantification already. Some have some inconsistent quantification, yes.
Doing something.
Yeah, doing something.
Which is better than nothing.
Exactly, at least better than qualitative ones. Yeah, so there are now a lot of research why just heat maps and traffic light systems are not good enough for professional risk management in cyber risk management. Yes, so I think this is a fair representation, and yeah, shows there also there is a lot of room for improvement and go this route.
Yeah, I mean, this also reflects also what our observation in the last 2 years, just talking with a lot of practitioners and, for example, chief risk officers or chief information security officers. So really, at least in Europe, the topic is still relatively new. So the market is maturing. In US, it's a bit more mature because, big technology companies and large companies in the US, they were affected, and the biggest cyber attacks started in the US with these large companies. So the market there for CRQ is very mature. And if we look here at the challenges, I mean, it's very interesting to see, of course, cannot be missed. And again, these are responses from you when you were registering for the webinar. We see AI and systemic risk as a big one, right?
Yeah, and I think this is a current hot topic. We will come later to it, especially third-party risk. This is a kind of systemic risk next to AI, but also scaling CRQ is a challenge, or seems to be a challenge. And yes, I think many started small, and that is always a wise approach, starting with something, a pilot cyber risk quantification, and then try to scale it, make it a company-wide one, right? And many started bottom up. Yeah, and I think, that is then the topic. What I see now at translating that is the challenge is really to come up with a corporate-wide risk quantification.
I see this board pressure. I liked this one very much because we are going to be touching on this later in the next minute. So it's also a good one. So, well, thanks for that input. So moving forward, before we get into some of our own predictions, and again, I mean, there are a lot of experts and, analysts, and we want to set the context. So talk a bit about the cyber risk landscape in 2026. So coming from 2025, and then, of course, we will get into some of our own predictions. We don't want to be repeating and obviously, when we talk about the cyber risk landscape, we already will be touching on some of these predictions and how we see things evolving and things you need to really watch out in 2026 from a cyber risk perspective. And we have different sources, of course. I mean, you heard about our Munich Re, a mother company, and there's a lot of data and analysis that Munich Re is doing, and we also will get a bit into that. But really, what is different? So cyber risk feels really different going into 2026. Third-party risk, we all know, is becoming one of the major threats. So companies being concerned. More than 40% of cyber attacks are originating from third party, and of course, third party is a very complex, it's a very broad topic. I mean, we're talking about not only suppliers. You have suppliers, hundreds of thousands, but you have external people. You have partners that maybe need access. You have also customers. You need to interact with your customers. So it's a very complex topic, and there have been also very recent, right, like very prominent cases, like in the UK, Jaguar Land Rover, which actually was a third party originated. I don't know if some of you know this. Really, it was originated because someone calling the help desk and getting credentials, and the help desk was outsourced to a third party. I won't mention the name, but it's really in the minds of many people. And this is not only about having a process to onboard your third party. It is also understanding what will be the impact to your company from a cyber attack originated from a third party. Also understanding how much you are relying on that vendor. So we are now hearing, also talking to prospects, asking for help if we can really help them to understand how much they're exposed because being too reliant on a third party. And then we now have the topic of cyber risk is now systemic. What does that mean, Herman?
Yeah, systemic has different dimension, but in essence, if there is a single cause, which has an effect and ripple effects into many other directions, and then become like a snowball, a big event. There is a small starting point, and that can affect either many companies at the same time, like CrowdStrike, one application with many companies, but even within a company, these are systemic ripple effects because of the supply chain within the company. One subsidiary is producing parts for another subsidiary, and then we have ripple effects. Or suppliers within a company have different effects. These kind of complexity has now been one of the most difficult pieces to manage the cyber risk.
And it's interesting here to say, even without malicious intent, because people think about cyber attack, it's malicious, but no. I mean, this can also be accidental or involuntary, and it's also a cyber incident. So companies also need to cater for this and be prepared for this.
So it's all about dependencies, understand external or internal dependencies.
Also sharing, of course, again, something from Munich Re. I mean, this is also very recent from the end of that last year. They always analyze the market, and here you see the main industries being affected when it comes to cyber attacks, and of course, which vectors are driving these losses. So we're talking about ransomware, scams, data breach, and supply chain. And you can see here, for example, in the case of manufacturing companies, and I mean, Germany is a very strong in manufacturing, is now the #1 industry that is most affected by ransomware. And also something I learned this morning in this forestry event. As a matter of fact, when it comes to which drivers are increasing enterprise risk, and manufacturing companies, they say 33% of companies said that they are concerned about the frequency and velocity of cyber attacks. So this was also corroborated this morning during this forestry event. And of course, you see the top 3 financial. I mean, they financial services, they have been also in the top 3 when it comes to being exposed and experiencing attack, but also We also have the data breach topic, and also the business interruption driving also the most severe paradox impact.
Yeah.
Can you comment on that, Samuel?
Yeah, especially for specific industries, of course, again, manufacturing or also high transactional banks, for example, or insurers are also can be hit and have been hit by business interruption losses. So yes, and they can be originated from ransomware. Ransomware is still one of the dominating piece. And when I went into that research of Munich Re, I found it interesting. There was one piece which said that only 15% of all ransomware incidents are publicly available, are published. 85% are still only known within the companies.
So under the carpet.
Under the carpet. And how can you get a feeling of risk if these are hidden and not really brought to the table? And how then can you quantify and try to make your own assumptions how you are affected?
Yeah. And we also learned from Munich Re that ransomware is driving the cyber losses when it comes to cyber insurance policies. But at the same time, many companies are deciding not to pay for ransom. But this is also difficult to get an actual statistics on that. How many companies are actually agreeing to pay for ransom?
Yeah. But on the other hand, we have had the highest ever paid and known paid ransom money, about $75 million. Dollars, I think, yeah. So
it's big, yeah.
It's big, and there's not enough transparency. But all in all, yeah, the effects of these attacks, be it business disruption, loss of profit, and also legal actions from data breaches, yeah, very often we have these double hit ransomware incidents.
Well, that's really a good lead into this slide. So talking about complexity, also this morning when the keynotes in the Forrester prediction event, there were two main themes, and so uncertainty, into a lot of uncertainty involved, and we don't need to get into the whole aspects going on with war and geopolitical situation, but also complexity. So real complexity. So here's the headline: complexity is the real risk multiplier, and what is changing? What has changed the cyber risk landscape? So really looking at, I think you touch base on that, on the things not happening isolated, but events now simultaneously having different consequences. So not having sequentially impact. So really, at the same time, you are affected your cloud, your supply chain, AI regulation, and especially when you have tightly coupled IT, OT, with manufacturing and third parties. Any small failure, even if it's small, it escalates and propagates pretty quickly. So make the whole things much bigger. And of course, insurers are preparing. In the past, probably they were trying to predict and be prepared for single worst case incidents, but now they really need to look at multiple extreme exposure scenarios at once. And then how risk governance deals with it.
Yeah, that's a big complexity driver as well, because regulations is scattered. Yeah, if you look into the landscape of large organizations with a lot of local, regional subsidiaries, it's always different. Every subsidiary has its own local. There are some global ones, but also local regulations to comply with. So how to do that? Yeah, the strongest regulation for all, or do you go a more differentiated way? A lot of things you can consider, and there are a lot of traps. Even time-wise, yeah, so you see now policymakers are not really good in being here in advance and give you a lot of planning times. Yeah, for example, the NIS2 implementation in local law in Europe the last years, it was a mess. Yeah, it was such an uncertainty. You for example, Germany, you have not known until the most recently that is now becoming to effect. So these are a lot of things. Yeah, that it's not just waiting for an incident that the regulators sit in front of your door. They just come, and now also for DORA, for financial institutions, they want to see, right, and know that most of the financial institutions are not fully complying, and they want to understand how good they are, so far. And do you have good answers to tell them we have a feeling where to start and where we need to invest most regarding this complex regulation?
Yeah, and it's obviously not only DORA. We have the NIS2 regulation is affecting critical infrastructure company. We have the SEC cyber rule, which is now asking for more transparency, and the board of these companies showing evidence on where they're mostly exposed and what they are doing to minimize that exposure.
And one of my most favorite one in the future is the Cyber Resilience Act, right?
Yes, the CRA,
that is coming, and that will produce strict liability to any product which has some digital component, some software in it. IoT, a lot of industries are affected, and it's really difficult to switch from a IT-driven risk management to a product line-driven risk management approach.
As with any presentation these days, AI cannot be missed. So there's a lot of hype. I mean, I'm a big AI proponent. Been done a lot with AI in the past. But of course, these days everyone's talking about it. So sometimes it's better not to talk about it because there's a lot of hype and a lack of results. But I think in the context of cyber risk, we need to talk about AI. So what do we know from Munich Re?
Yes, of course, all these risk drivers, but also from the protection side, I think this is fairly known at these more professional cyber risk managed companies. Small and medium-sized companies are still, they are struggling. But what I have a feeling that for large organizations, they have a practical approach. They treat AI as a special kind of software, third-party software, which they need to manage comparable to other software, right? They have some specific features, training needs, and so forth. So I have not the feeling that the larger companies are not aware about the risk. It's all about finding the right approach, to not to also hamper the innovation strength of AI. So CISOs want to be seen not just as a cost factor, they want to be seen as a strategic business enabler. And here AI is one of the most prominent factor for efficiency gains. And if security is hampered then that is not good. So find the right balance. I think this is the biggest challenge here.
Yeah, I mean, as with any new technology, it's also being used for good and bad. And it's obviously it's still work in progress, and it's also part of the quantification process, helping companies to understand how much they are exposed, because more AI is involved in certain decisions, but also in the actual operations.
Yeah. And for the future, I see it already now, also from the insurance perspective, from the loss history. So current losses which are AI induced, are already coming into the food chain of a model. So over time, the more AI losses are coming, the better the models can respond and predict also in the future.
Right.
So this is not a very specific thing. We probably need some specific controls here and there, but it's not really changing the whole risk.
It's not changing that's a very valid observation. Before we go into the predictions, I mean the board. So what boards are regulators and expect to see also getting into 2026? I mean, we saw that also in the survey at the beginning. So the board awareness. So obviously the board is becoming more informed. They want to be they want to have clear accountability for the outcomes. But most importantly is this third bullet here, cyber risk framework in business language. I mean, they don't care about a lot of technical jargon. They want to understand what is the impact to the business. So what are the impacts in financial terms? And of course, understanding what is being done. And even if the CISO, the CIO is going to the board, say, well, we are investing 20 million. They want to understand, is this 20 million being invested in the right buckets in order to minimize the cyber exposure?
Yeah, and how can you do that without quantification? Yeah, the language of board members is money, right? So they want to see a return of security investment numbers, and so the cost side is always evident, but the risk reduction of an investment, this is the secret, and therefore cyber risk quantification, especially for that, is the key success factor.
And of course, it's also mentioned readiness for regulatory escalation. We mentioned before, I mean, new regulation, DORA, NIS2 is demanding that they are aware of this risk and what is being done.
It's always, they do not require risk quantification. They know the regulators that they can't require that, but it's always in the text. They always call it risk-adjusted risk management. High risk should have higher investment, lower risk, low investment. This kind of thinking can only be done if you can prove that you put your investments into the right highest risks.
And obviously that being put in the framework of their risk appetite. So what is the risk appetite?
Exactly, yeah. So every company has a risk threshold, systematic for company risk, and that needs also to be established on cyber risk.
Yeah. Okay, so just understanding the complexity and the uncertainty of the cyber risk landscape, we just want to share two predictions also, just adding to what we were hearing. So from the Squalify perspective, and this is something that we have developed and we keep hearing from our prospects, and we now call it unified risk steering. So really helping companies, I mean, large companies, they have multiple entities, multiple subsidiaries, and it's no longer feasible to pretend to apply the same cybersecurity measures across the board, because these different entities, they have different exposure, they are different animals, and they also might have different maturity levels, especially if they are spread across different geographies. So really having the possibility to steer centrally the cyber maturity of these entities. So this is something that we see happening in 2026. Also finishing 2025, we saw a lot of interest and demand, and global CISOs, I mean, even if you have 5 subsidiaries or 10 entities, and I'm talking here entity subsidiaries, it can be a regional unit, it can be a country, it can be the manufacturing units. If you think about an automotive, very relevant in Germany, they have the manufacturing unit producing cars, but they also have the leasing and financial unit. So they're completely different entities. So you need really to look at them in the context of the business, what they're doing and the exposure, but then have a mechanism to steer them centrally. So what is this unified risk steering that we are talking about?
Yeah, it's all about really understanding the differences in exposure, right? So, for example, we had a company which had here in the US a strategy to grow by just acquiring local banks, one by the other, and everyone had his own legacy IT system. So, to combine them to one US bank with a lot of fragmented IT systems, that was one entity. Another one, there was a newly built entity in Asia, on the greenfield. The modern IT, what we can wish, and both of them had to comply with a certain kind of cyber risk maturity set by the group CISO. So, but they are totally differently exposed. So therefore, it's really important that you can compare different exposed subsidiaries or entities with the same metrics. And you
can benchmark them.
And it's not just benchmarking by the maturity level. It's also important to benchmark them as well at the same time with the exposure level. Some companies are highly transactional Yeah, and so business interruption is a biggest risk, and others are much more here on data breach. Yeah, so therefore you need to be differentiated, but with the same financial metrics.
Yeah.
And then you are able to steer them and can give them certain kind of targets.
Yeah.
Yeah, that all, if they achieve from different standpoints to the group target, then you have a steering mechanism, which is not really like we call it Gießkanne, yeah, just one fits all. It's really something where you have a risk adequate investment.
Yeah, very clear. And there's another prediction that we made also and was published regarding cyber insurance. So really increasing. What is this about, Herman?
Yeah, especially large organizations have understood over the last years that this new kind of insurance product is a valuable part of the risk management tools they have. Yeah, you can avoid things, you can mitigate, yeah, but also you can transfer the rest risk. But what is a risk, right? How much risk do you want to take on your balance sheet? If you have no quantification, how can you have at least a risk philosophy to say what is it still within the risk appetite? And if not, what kind of limit for cyber insurance you want to buy? Yeah, this is only possible if you have a certain kind of risk metrics.
Yeah. I mean, we as Squalify, we were not in the business of selling cyber insurance, but it's interesting that, of course, when you quantify, you can decide and determine what is the right limit for cyber insurance. And we predict that there's going to be an increase of 2-digit percentage in terms of the uptake of cyber insurance policy. I mean, the uptake is still not at the level that it can be.
No.
And we have prospects that they don't have cyber insurance. That others say, okay, I have a 10 million exposure based on the probability, annual probability and annual potential loss. And they can say, well, from the 10 million, maybe I will try to cover 2 million with a cyber insurance policy. The rest, I'm going to try to have the right measures to reduce. So this, again, each company make their own decisions, but this is proven to be an important part of the mix when it comes to being cyber resilient.
Yeah. There's a huge protection gap. There's still here in the mid-market, for example, a lot of not our underinsured companies out there. And we have seen that after some of our projects, companies have clearly decided, oh yes, knowing now the numbers, yeah, we will buy it.
Makes sense.
Yeah, or we buy just for business interruption, yeah, very specific, yeah. So then you have a much clearer negotiation standpoint in front of your brokers or with the insurer.
And then you have the extreme cases, again, going back to Jaguar Land Rover in the UK, where no cyber insurer will have been able to cover the costs on business interruption they have suffered in the last months. So it's like an extreme case. So it's not only about cyber insurance. Before we open up the Q&A, yes, I mean, obviously we are reacting to this. We are aware of, we have we are measuring the pulse and talking to prospects, talking to partners, talking to analysts, and we are responding to this and making sure that the product is catering for these needs and assisting companies to be better prepared for these challenges coming in 2026. Like the way we report and put all this information for the boards, you can see here some examples on how we present. We call this the board of management report. The subsidiary steering, something we have been doing now in the last months, and we have several customers using that. And of course, when we talk about large companies and subsidiary steering and integration with existing enterprise risk management system, of course, we need to offer integration, and this is expected. So we already have our public API for system integration and automation. So with that, we're basically on time almost. And let's open up for any questions. We have some questions. Let me see how I see that. Maybe I need to stop sharing my screen. Okay, some additional help here. So we have a question from Chris Henning asking if in the transportation, I mean, we saw the chart of the industry affected. He's asking if shipping is included in the transportation industry.
Yes, I assume so.
Yes.
Yeah.
It should be included. We assume it's included in that statistic. Does a Squalify Munich Re offer cyber insurance to shipping? I mean, many it's not excluded, right? I mean, we don't know.
We are not in the insurance business. Yeah, we are explicitly a separate company just to be independent. But from my knowledge, I do not see any.
Why not?
Why not? A reason not to include that.
Yeah, I mean, it's not. There's no cyber insurance for warfare, so right. So.
Yeah, no. But in principle, they might have different risk appetite. But I think no industry is explicitly excluded.
No, I don't think it's excluded. So those questions.
Do you have enough cases to be able to assess?
Yes, I mean what we do. I mean, we didn't want to talk a lot about Squalify, but we are talking about more than 100,000 companies that have been documented in the last 11 years, and this spans across 130 industries. So we have all the industries represented and across 80 countries. And normally what we do when a prospect comes to us, we can always check, do we have enough meat in the model and the database to give you a good benchmark. Up to now, we haven't said no. So we normally always have enough data points to give you a trustworthy quantification. But I can tell you top industries are financial, manufacturing. We are very good in IT and technology companies.
Yeah.
But again, there are a lot of industries well represented in the model on the database. We have another question from Chris. Thanks, Chris, for all the questions. Keep them coming. Are you able to quantify the service in shipping since there are few reported incidents and it's a globally sensitive reputation loss? Yes, I mean, we're happy to take the challenge. I mean, again, we haven't said no to anyone in terms of that we cannot do it. No. Because the insurers, they not only basing decisions on history and known cases, they're also predicting the unknowns. And
we have seen the very public Maersk case, which was a huge case study for analyzing extreme events. Yeah, also Munich Re has learned a lot about that. We are analyzing every large risk, but also the model is influenced by a lot of frequency risk, and also try to compare the exposures with the losses. Yeah, this kind of analytics can be done only if you have enough loss experience. At Munich Re, I would say nobody can have more, because as a reinsurer, we also
it's the largest.
Yeah, we also have a lot of primary insurance losses in our database, and anonymized, but detailed enough to have really industry and company specific statistics and trends.
And it's also interesting to point out, I mean, the model that we are using. Of course, we have the history, but it's being constantly updated. I mean, you have all these claims happening that nobody knows, but also the cyber landscape is changing. I mean, the hackers becoming more sophisticated with AI. So this is constantly being evolved and updated, the model parameters and the frequencies and the amount of losses. Yeah. So this is kept alive.
Yeah, it's a question of survival of a reinsurer. Yeah. If they miss a trend, then they will lose money. Yeah. Because it's not just a model. Yeah. So this is, I think, one of the biggest assets we have, that this model is tested in practice. Yeah. So if Munich Re is not updating the model, then either they are too expensive or they lose money.
They have skin in the game.
Yes.
All right. So. Any more questions? Oh, show me. There's another question from Vittorio. With respect to traditional backup and recovery capabilities, how is insurance different? Is this about outsourcing, externalizing the recovery capabilities across industries, or is this focusing on protecting assets via deliberate risk discovery process, capital allocation?
Okay, interesting question. I would say neither nor. So, in my kind of understanding of cyber risk management, risk management and controlling risk, preventing risk comes first, right? And it's all about the degree of prevention and also prepare for an incident where is crucial. Yeah, it's also crucial for insurance. Yeah, no insurer will cover a company which has not a minimum protection level. Yeah, that is the entry card. Right. But the more you protect, the lower is the financial exposure. This is something what we can prove. Yeah,
so it reduces your exposure.
Yeah. And that makes it interesting. Yeah, how much investment is really needed to come up with an exposure, a financial risk, which the company wants to take on its balance sheet. Yeah, and that is then the secondary question, where then risk transfer can help reducing the burden of the balance sheet. But we are all aware, and insurance has also its limitation. It has a limit and also can cover all cyber losses. So therefore, anyhow, the company needs to decide about the maximum risk they want to take consciously.
Yeah, and I think whether it's outsourced or not, I mean, depends. Doing that as an outsourced activity doesn't mean that it's good or bad. We just need to get the right one. And one of the things that we do is to also help companies understand where they're lacking. So showing them, okay, if you invest and improve the control behind that backup capabilities, then you should be investing more on that.
Yeah, especially backup and recovery capabilities have a higher impact than other controls because they have been proven to be really risk reducing effective.
Yeah, so it's risk reducing. You mentioned it now. So we also are able to simulate. So before you actually embark in an improvement program, you can simulate the impacts. So you simulate improvement of certain areas, and you can see immediately what is the impact to your risk if you improve those controls.
Yeah,
that's one of the advantages of the cyber risk quantification. Do we have more questions? We have here our Master of Control helping us with the logistics of the webinar, Niklas.
No,
I don't see any questions. Anyone? We're basically on time. We wanted to finish at 45. So there are no further questions. I mean, we will, of course, share the slides and the recording. Also, for those that could not join, feel free to forward also to other colleagues. And of course, if you have any questions and you would like to continue a dialogue, you know where to find us. Thanks a lot for joining today. I hope we could give you today a bit of insights and inspiration for the rest of the week and for 2026. Have a great year, all of you.
Yeah, also from my side, all the best and good luck.
Bye.
Bye.
Thank you.